Welcome back to QAV America, Tony. I think this is episode 11. It's been a big week, Tony, since we
Well,
last talked.
especially for America.
Bombing. America's back to doing what it loves best, bombing other countries. Love a good bombing.
Oh,
It's
indeed.
funny, I read the New York Times every day, as you know, and most of their articles are negative towards Trump and the Trump administration. As soon as he starts bombing somewhere, it's been interesting to see how the New York Times started to rally around the,
Really?
say what you want about Trump, but he's doing the right thing here. This is, you got to bomb Iran. This is good. This is good, Trump. Trump's finally doing something we agree with, bombing another country.
It's had its effect on the oil market. Not sure it's had an effect on the stock market yet. Too much.
No, it's the stock market. Well, it did. It dipped when people thought, well, I don't know, maybe maybe they're gonna block the Straits of Hormuz, but nah. Then it sort of rebounded after that. Everything dipped for a day, and then they got over it. They decided it was taco bombing, and they they recovered. Uh,
That's
so the
well. The
latest
market
news.
went up today because Trump declared a truce, a ceasefire. Job
Trump
done. Mission accomplished.
Trump said that there was a truce, and then Iran and Israel came out and said,
Hmm.
"What?
What?
Uh, what? We're not aware of that." But yeah, market got on the front foot, and I thought I would start this with just reviewing our portfolio. So, in the last 30 days, our US portfolio is up 6.89% versus the S&P 500 up 3.83%. So, been a good month for us vis-a-vis that. Year to date, though, our portfolio is still down 17.4% versus the S&P 500 up 2.4%. But over the last 12 months, we're up 33.3% versus the S&P up 10.2%. So we're still doing 3 times the
Hmm.
market over the last 12 months, which I'm not going to complain about. It's pretty good. The big winners in our portfolio, well, let's do. I don't think Stockopedia, it doesn't change when I change the time frame. Big gains. Willis Lease Finance is still our biggest. It's up 199% since we bought it. What's next? BLX, Foreign Trade Bank of Latin America, is up 68%. Innova International, ENVA, is up 67%. EuroC is up 65. Gas, GASS, which is Stealth Gas, up 33. Optimum Bank Holdings, OPHC, is up 32%. KT, your initials backwards, up 28%. Regional Management, up 20. Sarkos Energy Navigation, another shipping company, up 16. Danaos, another Greek shipping company, up 6.84. UBS, up about 1% since we added them. And the big loser is the one that I did the pulled pork on a few weeks ago, NL Chile, the company that builds mobile phone towers
Hmm.
everywhere from memory. They're down 10% since we bought them. So haven't looked into that. Not sure what's going on there. But all in all, portfolio is doing pretty good in a very frothy market. And we don't own any of the MAGA 7 still.
Hmm. No, all value stocks. And just to prove that they can grow as good as the Mag 7 or the growth stocks.
Not sure they're doing as well as the MAGA 7 stocks, but they're doing okay. I saw a Tesla. I was out going out to dinner last night in Brisbane, and I saw a Tesla parked in front of me that had a sticker on the back that said, "I bought this before I knew Elon was crazy." So please don't key
Mm.
my car, I guess, is the thing. I said to Chrissy just the day before that we saw a Tesla. I was like, I wonder how many Teslas get keyed these days. I wonder how many people walk
Mm.
around keying Teslas. not the Tesla owners' fault. Anywho, I have a pulled pork to do on a company called PDS, or Precision Drilling, ticker PDS today, Tony, Canadian company.
Mm.
Do you have anything about the American market you want to talk about before I get into that?
No, I mean, we just touched on the fact that the oil price is swinging. It's quite volatile. It's was a buy last week. It's back below its buy price now. It did drop after the ceasefire was announced today, and people weren't as worried about the Straits of Hormuz being closed, and so that's kind of depressed the oil price again. But who knows where it's going to go to from here? So in the Australian sense, a lot of our oil stocks have come off today. They were bolstered by the rise in oil last week, so we'll see what happens. Do we have any? I don't think we have any oil stocks in the US dummy portfolio, do we? And not as
No, we've got
prevalent in the US.
got a lot of shipping companies that are shipping oil, but not oil companies per se. And the one I'm going to talk about today, Precision Drilling, is a Canadian company that makes oil rigs. They're specialists in making and running oil rigs that they contract out. And it was really interesting, as I say every week, because I know nothing about any of these businesses. And it was just really interesting to learn about what's going on with state-of-the-art oil rigs, lean, mean, technologically advanced oil rigs, which is what these guys do. But couple of caveats before I do it. So I haven't run a new checklist since the one I did at the beginning of June. Their share price when I ran this analysis was about $47.78. Today it's $48.03, so it's up a little bit, but I reran the scores. It didn't change the scores. The other caveat, though, is like the Japanese one I did last week, Oryx. In Stockopedia, the reporting for all of this isn't in USD, it's in Canadian dollars, but the price is in USD. So not a lot, but a few of the scores that we have in our checklist assume that they're all in the same currency. They're not, so I had to go in and fix a couple of the scores. Didn't change it dramatically, but I'll get into that later on when I do the scoring. But just again, for any listeners out there who are using the spreadsheet that I built for Stockopedia for stocks on the New York Stock Exchange, just be aware of the currency difference and check it. If you're looking at buying something, just check it. Check the currency that it's reporting in Stockopedia and adjust your numbers. So far, as I said, it hasn't made a great deal of difference, but you don't want to get caught out. For reference, one Canadian dollar at the moment is worth 72.9 US cents.
So it'll make it easier when Canada becomes a 51st state of the US. We'll get the same currency across.
Yeah, I'm pushing for that. For just to make my life easier.
Makes life easy. Yeah.
Get it done, Trump. Don't taco it. So a little bit about Precision Drilling. They build, own, and crew land rigs that punch holes in the ground for oil and gas producers. Then they rent out the rigs, camps, tool packages, and keep the wells flowing. So they're like the landlord and handyman rolled into one for shale and oil sands operators. This, we will bring in the rig, maintain the rig, and get the whole thing up and running for you. Which is kind of seems weird to me that all of that side of it is outsourced. I kind of think of oil companies as doing it all, sort of soup to nuts, but like everything these days, like the mobile phone operators we talked about, the mobile phone companies, the telephony companies don't actually own the mobile phone towers in some cases. Somebody else comes. These guys are basically the oil rig version of NL that I talked about a couple of weeks ago. You don't have to worry about the oil rigs. We'll take care of the oil rigs. We'll build them. We'll run all the tech. We'll maintain them. Drop them on your land. Run the whole thing. And you don't have to worry about it. So, yeah.
Well, it's the old adage of buying picks and shovels and a gold rush, isn't it? So you're getting a company supporting the gold rush. You don't have to care about where they dig for gold or oil in this case. You just are happy that people are going to rent the picks and shovels from you to do it.
Yeah. Launched in 1951 when two entrepreneurs in Calgary bought a single wooden derrick for 25,000 Canadian dollars and nicknamed it Old Number One. And then there was a post-war drilling boom in Alberta at the time. They ended up having 10 rigs by the end of the 1950s and earned a reputation for being fast and furious to get rigs out there and get oil out of the ground. 1987, they were taken over by a company called Cypress Drilling, and the entity floated on the Toronto Stock Exchange, gave it a lot of money to go and start rolling up competition, and they set up a buy the fleet, keep the crews playbook that drove 40 bolt-ons through the 1990s super cycle. Buy the fleet, keep the crews just basically means they walk up to a mum and pop drilling operation, cut a check for the rig, and keep everybody on staff. Basically, keep them all part of the operation. So they did a lot of roll-ups over the years. They survived the 2015-2016 oil crash by parking half of their rigs, slashing their overheads by 45%, and then they did a lot of refinancing in 2020 at pretty high rates. They issued a lot of bonds at like 6-7%, high sixes, low 7%, which is they've been buying out with their cash, doing early cash outs with those to reduce their debt. But I'll talk about that a little bit more later on. But a lot of their peers in the US got Chapter 11 during the sort of oil crash, but these guys managed to finance their way out of it, cut their costs and refinance their way through it. One of the biggest things that they've got going for them, which isn't unique, but is one of the key interesting things about them as an operator, is in 2017, they launched a series of what they're called Super Series rigs, the Super Single and the Super Triple. These are pad-walking, AC-powered, high-torque units designed for North American shale laterals, and it's now 72% of their active fleet. So let me break all that down if anyone listening to this, like me, knows nothing about oil rigs. So these are like the EVs of oil rigs, basically. Super loaded with high-tech oil rigs. A Super Single is a compact trailer-mounted unit with one pump set and a high-torque top drive. It drills shallower horizontals and runs off a single motor, can be hauled down a highway behind two prime movers. You roll it in, level the pad, flip up the telescoping mast and start making holes before lunch with this thing. It's crazy. It's all full of touch screen, Tesla-like tech. I watched some YouTubes, guys sort of running these whole things. It's all, it's like super high-tech stuff. Then they have the Super Triple, which is the beefed-up big brother of this thing. It has 3 pump sets that you can use for getting down into Permian laterals. Same AC engines, but double the volume, stronger iron, and they can rip down 7,000 feet per day, which I believe is 2 Empire State Buildings top to tail. In a day, it can drill down. So, and one of the other cool things is, I said pad walking feet. They have hydraulic shoes that can crawl 30 feet sideways in an hour. So you basically set up an oil rig, don't like where it is, move it down 30 feet, drill again. Don't like that? Move it down 30 feet. Next day, drill again. So, it's like walking oil rigs. And they have this thing called, this system called alpha automation, sensors and software that stab pipe, manage weight on bit, and cycle mud pumps. Sounds like one of those fake tech videos where they just make up, names.
Sounds like an AI nightmare when the computers take over these walking drilling machines. That's going to give me nightmares.
Yeah. They're going to be marching on the humans. I was on a Reddit thread the other day. Somebody was complaining about the way that AIs today will glaze you. They'll be like, you say you did something, like I'll say that I brought in my calories for the day under 2,000. They're like, that's not just dieting. You're rewriting the book on calorie management. They're always like telling you you're an absolute, and people were complaining about this tendency. And I'm like, I don't know what you're complaining about. A few years from now, you'll be looking back on the days when AIs used to tell you how great you were when they're hunting you down instead. Maybe with movable oil rigs hunting you down, trying to punch a 7,000-foot hole through you. So basically, this alpha automation system, one driller in a control room in Houston can babysit 3 rigs, manage the whole thing remotely. You still need an on-site crew, but it reduces it from 22 headcount to 14 headcount. They also have a battery hybrid evergreen system. It's basically a battery hybrid pack. It charges while drilling and then discharges while tripping. Diesel engines idle, noise drops, CO2 shrinks, and the rig passes the new emission caps that places like Colorado and Canada have. So these are like sustainable, environmentally friendly oil rigs that have a lot less diesel usage, and
So when you drill the oil out of the ground to then use in the engines to produce the carbon, you do it in a green way.
Yeah.
Good on the government for coming up with that legislation.
Don't think too much about it, Tony. You do your head in. No. It's all good. It's all green. Look, you know it's green because they used it in the name, evergreen, Tony.
Right.
Evergreen. You know it's good. They've got other stuff too. The quick rig mast system. No cranes, no 12-hour rig ups, fewer hands crushed by monkey board slips. You just whip these things up and off you go. So anyway, bottom line is, same hole in the ground, but half the time, fewer bodies, less diesel, more day rate bonus. It's about speed and high-tech remote management. And if when the next oil crash happens, you've got lower costs. You can shut these things down, get them up and running faster when the shale oil price, as we know, we've talked about it on our shows over the years. Shale oil operators run up and shut down depending on where the oil price is, whether or not they can be profitable or not. So anyway, that's the bottom line of what they do. They've been doing a lot of deals. They're buying lots of stuff. They've got a lot of contracts. There's a big contract coming up in Canada, which I'll get to in a minute, but They've got operations not just in Canada, but different parts of the world. Canada's about 58% of their business, though. The US is about 31%. Kuwait, Mexico, Panama together make up about 11%. I think they've got some stuff even in Australia, but that's the majority of it. International rigs, though, get a 40% higher day rate, and they have deals, usually 3-year take-or-pay contracts. They're locked in, so even if it doesn't go ahead, they still get some money out of it. The headquarters are still in Calgary, but they've got a second hub in Houston where they're working a lot of stuff in the US, and their listing on the New York Stock Exchange gives them access to cheaper debt in the US, apparently. Headcount sits at about 4,500 people today, roughly half what it was pre-COVID. but also the alpha automation and all of the rig sharing stuff that they do lets them operate on much lower operating costs and with lower people. Guess, part of the AI job revolution, but hitting more blue collar guys. Why it's working and why it's cheap for us, they're generating a lot of cash. Operating cash was US 480 million on a $647 million market cap. Their price to operating cash flow is about 1.8 times.
Mm.
So from our perspective, really cheap, 2-year payback on a prop CAF basis. And trying to work out why it's cheap is interesting. Like, because the oil price comes and goes, I think it scares off a lot of institution investment in the US. They're also carrying a lot of debt, as I said, from this refinancing that they did in 2020. But they've also been slashing it. They've slashed 750 million debt since 2018, and another 100 million of high coupon notes are callable in October 2025, which they're going to buy off or buy down with their cash. So they're spending cash to cut their debt rate and refinance at much lower rates. So they're doing a good job of that. But the market, apparently, from what I can tell, looking at some of the analysts' comments, the market still suffers from PTSD from the collapse in 10 years ago, 8, 9, 10 years ago, when there was a lot of wipeouts, a lot of companies went belly up. So they're a bit shy of this, but from our perspective, it looks pretty good. Depends on the price of oil and natural gas, depends on the rates that they can get, those sorts of things. But even as they are, they're generating a lot of cash and their price is quite cheap. They've got this project in Canada that I mentioned. Canada's got a project called the LNG Canada project. Goes live round about now, scheduled to go live mid-2025. It's a $40 billion export terminal for Canadian dollars, that is, in a place called Kitimat. Do you know where Kitimat is, Tony?
I've heard of it, yeah. It's
On
northeast from memory.
northwest coast of British Columbia.
West, sorry. Yes, British
Yeah.
Columbia. Yeah.
The other east.
Yeah, thank you.
Reverse the
left-hand.
polarity. It's on the other
Yeah.
side. Yeah. So, as I understand it, most of the gas that Canada has traditionally has been bottled up and sold into the US Midwest. But what they're going to be able to do with this new export terminal is chill it down to a negative 162 degrees Celsius and then turn it into liquid, load it onto tankers bound for Asia, and coming straight out of this new export terminal in British Columbia, it's going to cut the amount of time it takes to get it to Asia compared with Gulf Coast routes. And they're going to be able to get much higher prices in Asia than they get in the US for this LNG, apparently. So big deal for Canada. Precision already has 16 Alpha rigs contracted on a 3-year take or pay deals as part of this whole thing. So they've got some big deals coming up. If everything goes well, they should have a good few years at the very least. So, what else can I tell you about these guys? There's a lot of work they have also with the big super majors, as they're known, the Permian super majors in the US, Exxon, Pioneer, and Chevron Hess. That apparently there was a bunch of mergers there. Exxon bought Pioneer National Resources for $60 billion last year. And Chevron is buying Hess Corp for $53 billion. So they're now the super majors. These guys Precision have got some good deals with them as well. So what else can I tell you about them? The stock was slumping recently, but then it beat the street's forecasts in Q1 25, managed to turn around a little bit. It doesn't have a dividend, so that keeps the income funds away, but it's been doing a couple of buybacks as well as getting rid of debt. Buybacks retired 7% of shares in the last 18 months, and then there's something to do in Canada called the NCIB, Normal Course Issuer Bid. Basically says they're allowed to buy back up to 10% of their public float over 12 months, and the PDS have announced that they're taking up that option for this year. They're going to buy back another 10% of their stock. They re-upped the permit, as it says. So they're taking shares off the market, which is good for shareholders. I know Warren prefers that to dividends, right?
Mm-hmm. Correct. Yeah.
Buybacks?
Well, because you get 10% more share of the profit. So the price should re-rate.
Yeah. Bottom line from our perspective is a lot of cash coming out. Their rigs are getting smarter and smarter. They're getting rid of their debt, and the market's steering clear of them from what I can tell, just because oil field services are sort of touch and go. Some of them have gone bust.
I don't know. It's interesting, isn't it? Like we have similar companies in Australia. Parenti's done very well this year. It's a drilling company in Australia. And sure, they're cyclical. If the oil price drops, there'll be less drilling for oil. That's pretty obvious. And one of the key metrics that people should look out for in a company like this is the utilization rate. So they might own 100 drilling platforms, but how many are being rented out at any one time is the important thing, and for how long. So I don't know if you came across a utilization rate, but you'd want it to be very high for a company like this. So that's one thing to watch if you're going to invest in this company. But I imagine at the moment, the oil price is getting up there, so the utilization rate should be pretty good, I would have thought.
At the moment, their US utilization rate is only 55%. Which
that's
means
why they're not being bought. Well, the stock isn't being bought then, probably.
Yeah, but it also means they've got a lot of upside if the shale price goes back up, right? Or the oil
well,
price
that's
goes
also
back
a really
up,
good thing for them. But if they're throwing off lots of cash now with half the rigs in the US sitting idle, that's actually a good sign, I think.
Yeah, maybe. So anyway, let me go through the numbers. Their PE is 10.5, which is pretty low, I think, compared to some of their peers. Price to operating cash flow, as I said, is 10.8, which 1.8, not 10.8, 1.8. So that's very, very cheap from our perspective. Free cash flow yield is sitting around 40%. So if you strip out their maintenance capex, they still have about $259 million a year. If you look at their valuation of about $647 million, you're banking about 40 cents on the dollar, which is pretty good. Return on equity is 6.6%, which is pretty low, but the rigs are fixed cost. So the more utilization they can get out of them, or if the day rates can get jacked up by a little bit, the profit balloons. The fixed costs that they've already bought and paid for, really. So they have a little bit of manpower, but these high-tech rigs are not as requiring of manpower, and they can also jack up the day rates. I said if there's suddenly a big bump in oil prices.
I mean, I don't know much about this company, but I imagine if they're high-tech rigs, they're asking a higher price than some of their other competitors too, which might be an issue for them. If the oil companies are sensing that, or they're doing it tough, they might go for the cheaper option. I'm not sure.
Well, my take on it is these are the cheaper option because they're faster and they require less manpower. And they're not unique in this. There are not a lot. There are other competitors producing similar sort of high
Okay.
tech, highly automated things. They're not alone in this, but it's not a hugely crowded space either. And they're one of the guys on the cutting edge on this.
Yeah, I mean that whole business approach is the right way to look at it. But experience says that people will still take a cheaper option if they're squeezed, and if they've got staff sitting around they can utilise, they might happily not maximise their profit overall just to save some short term costs.
But what I gather from this is they don't have staff. These guys, I think, crew a lot of the rigs as well. They provide
Right.
I think it's optional,
Oh,
but I
okay.
think they provide a lot of
Turnkey.
the crew as
Right.
well. So you just, yeah, soup to nuts. You just buy the thing. Yeah, you just bring these guys in and they run the operation for you. You just
Mm.
do whatever else there is to be done, I guess. Take the oil and refine it or distribute it or, probably outsource all of that as well. I don't know. The price to book is 0.52. So it's very, very low. On the negative side, their Altman Z score is 0.18. So we tend to ignore the Z score, but it is in classic distress territory. Means that if anything goes wrong, they could go, when they can't pay their debt, they could go belly up very quick. But that's why they're paying off the debt. I guess they're trying to pay down their debt as quickly as they can, which will lift their Z score over time. That said, the health score, the F score is 6, above
Hmm.
our hurdle. So we like that. Stock rank and the quality rank are all pretty middle of the road. Stock rank's 54, quality rank's 49. So not rated high in that respect, but our quality score is a little bit higher. Dividend yield is nothing. As I said before, not really paying a dividend.
Hmm.
But the operating cash flow per share is pretty good. Anyway, by the way, the prop cap, not the prop calf, the ADT is about $6 million a day. So a lot of liquidity in it.
Hmm.
Let me run through the numbers. What haven't I told you about? Prop calf we did, gets a score for that. Quality rank it doesn't score for, it's below 60. Stock rank it doesn't score for. Does get a score for the F, doesn't score for the Z. Price is, as I said, about 48. The IV1 is $32. So the price isn't lower than our intrinsic value number one. It's also does not score for IV number 2. Let me just check that. I had to redo the numbers on these to adjust for the currency.
Hmm.
Let me see. Yeah,
Adjust for the loon.
IV number 2 when I recalculated it was $40 and the price again is at 48, so it doesn't get a score for that. It did get a score for that in the original run, but I had to back that out. Does have a new 3-point upturn as well as a positive 3-point trend. Growth over PE doesn't score for that. Price less. Oh, what just happened? Just broke my notes. Price over book. Yes, it does score for that, and the checklist is all currency converted for that, so that one is good. The other one I had to check was forecast IV greater than 2 times price, and forecast IV is $23. Hold on, that's not right. What's the
Other way
forecast
around,
IV
isn't it?
again? Forecast IV is $40. B13. That's where did I get? No, that's IV1. You dummy. Forecast IV is $40. All right. 2 times the share price would be $95, so it doesn't score for that either.
No.
What else have I got? Book value growth. It does get a score for book value growth. Book value growth has been good.
Okay.
PE is not less than the yield because the yield is 0. The yield is not greater than bank debt because the yield is 0. So, all told, when I redid all of the numbers, we gave it a quality score of 53%. Not terrific, not shooting the lights out, but a QAV score because of the very low prop CAF of 0.29. So
that's good.
Still came out good. But yeah, it's one of those ones that, yeah, there are some risks there, but it's generating a lot of cash and it has some potential upside. Been around a long time, seems to be really well managed. As I said, I was impressed with the way they got through the shale crash in 2016, 2017, cut their costs, refinanced. Now they're paying off the debt, getting back on a solid footing. And we have sell mechanisms in place if we get it wrong and they go belly up, like NL, which is down 10%. So you talked about it. But yeah, anyway, so that's Precision Drilling, the Tesla or the BYD of the land oil rig business.
Yeah, well, you should go and watch Landman now about the land oil rig business, what they do there. They don't have oil rigs anything like you're describing, but they do have a company that sends crews out to work the rigs and check on them, et cetera, and they battle with cartels who don't like to be interrupted in their businesses, and yeah, it's a good show.
What was that again? It's a TV show. That's on SBS
yeah,
or something you
Landman with
watch?
Billy Bob Thornton. No, that's on Paramount Plus.
Oh, right, Landman. It's a dramatic series.
Yes.
Oh, yeah, right. Yeah, you told me about that. Landman.
Yeah, good show.
Anyway, we don't own PDS. It's not in our portfolio because I haven't had to sell anything and buy anything recently, and we're fully invested. But I would. I kind of liked it. I was impressed with all of that operation. It was cool. Not that I think oil is great, but for the moment, it seems to be part of the energy mix, whether we like it or not.
No, I agree. If you don't like oil, then don't buy the stock. But thank you for that. It was very interesting. And taking me back to my roots in the oil industry.
And I can highly recommend jump on YouTube and watch some of these videos about these automated oil rigs and see how they run. Like, it's crazy. I mean, in my head, I think oil rigs are dirty and guys out there with pumps and levers and these guys are like beep, 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 and it's all happening. And
yeah, right.
It's as I said, running oil rigs from
good.
Houston.
I couldn't imagine being an oil rig worker in Calgary. It's a very cold place. Up near Banff and the ski fields in Alberta and all that, which is where Shell was based, in Alberta. I had a boss who had come back from Calgary working for Shell, and he regularly said it got to minus 45 degrees and everyone pretty much lived underground. So it didn't sound like the sunny, fun place Brisbane is in Australia, but anyway.
Yeah, no, and like the whole walking oil rigs thing blew my mind. Like, it's like something out of Star Wars. It's like huge machines that can get up and move. It's cool. Anyway. Well, that's all for QAV America this week, Tony. Good luck to everyone in America. Happy bombing. Hope you're taking a break on your bombing for a while.
Happy markets.
Yeah. Happy Nissi.